Benefits of deferring taxes. While it is impossible for individuals to avoid taxes with most investments, it is often possible to defer taxes. Deferring taxes over long periods of time can result in potential gains. While holding investments subject to taxation, it is possible to defer taxes by delaying the sale of the investment, not realizing the gain. However, taxes on income, such as coupons or dividends, must be paid annually. The impact of taxes on an investment portfolio can be reduced through the use of tax-deferred investment vehicles. Examples include individual retirement accounts, or IRAs, company-sponsored 401k plans, 403b plans, KEO plans, and tax-deferred annuities. Talk to a professional investment advisor to learn more about the differences between these tax-deferred investment vehicles, and to your employer to learn about plans sponsored by them. Tax-deferred vehicles work by allowing interest, dividends, and capital gains to accumulate without incurring taxes. Taxes are due only when withdrawals from the plan begin. This image illustrates how deferring taxes can increase the value of an investment over time. A hypothetical value of $10,000 is invested in both a taxable and a tax-deferred account. The difference is fairly modest after 20 years. After several more years, however, the difference is more substantial. Allowing the investment to grow tax-deferred for 35 years would have provided approximately $9,256 more than the taxable account. After 45 years, the difference is even more dramatic. Returns and principal invested in stocks are not guaranteed. Deferred investment accounts such as IRAs, 401ks, and annuities are long-term tax-deferred investment vehicles. Withdrawal of pre-tax contributions and/or earnings will be subject to ordinary income tax and, if taken prior to age 59 and a half, may be subject to a 10% federal tax penalty. Changes in tax rates and tax treatment of investment earnings may impact comparative results. Investors should consider their personal investment horizon and income tax brackets, both current and anticipated, when making an investment decision, as these may further impact the results of the comparison. About the data. This hypothetical example is for an investor in a 28% bracket using the 2017 tax code established by the American Taxpayer Relief Act of 2012. $10,000 is invested in stocks at the beginning of year 1, 2017. It assumes an 8% annual total return, 6% price return, and 2% income return, and a 15% tax rate on capital gains and dividends. The data assumes reinvestment of capital gains and dividends and does not account for transaction costs. Taxes are assessed yearly on the taxable account, but only at the end of the period on the tax-deferred account. Estimates are not guaranteed.